and welcome to Livewire's listed series for 2024. I'm Ali Selby, and today we're incredibly lucky to be joined by Qualitas's Head of Income Credit, Mark Power, for a deep dive into the alternative real estate sector. Thank you so much for joining us today, Mark. Really excited to feature you in our listed series.
Oh, you're very welcome, Ali. I'm really pleased to be here.
I want to start with a subject that everyone's discussing right now around dinner tables. It's the housing crisis. How many new dwellings are needed to solve that supply-demand equation?
Yeah, you're right, Ali. It's such a topical conversation at the moment. And the unfortunate thing about it is that not is it only that it's topical, it's taken a long while for us to get to where we are today in terms of this acute need for housing or housing crisis. But it's actually going to take a fair while to actually get through and out the other side as well. So if you look at unpacking that in terms of where we are today, a really good place to start is the residential vacancy rate, because that kind of tells you how the market's performing from a demand supply point of view. Now, at the moment, that's 0.7%. Now, that's unprecedented lows. I mean, if you think about a market which is in equilibrium in terms of residential vacancy rate, generally runs at around about 2 to 3%. So 0.7%, your starting point is chronic undersupply. So that's where we are today. Then we look at what the demand drivers are for the need for new dwellings coming through into the marketplace. And essentially population growth is a very big driver, obviously, of the demand for new dwellings. And if we look at that population growth and break it down, once again, that's running at unprecedented levels. So the net overseas migration number for the 12 months to June 23 was 517,000 positive for Australia. Now that ignores the natural rate of population growth as well, which is a further 90 to 100,000. So all those people have to be housed. To put that in perspective, in the 10 years pre-COVID, the net overseas migration number was running at about 217,000 a year. And
wow.
that was then considered incredibly high. So 500,000 plus is just extraordinary, and that's what's creating what we're seeing in the market today. So in terms of what needs to be provided is a lot more housing at the end of the day, a lot more supply.
Can new supply keep up with this ramp up in demand?
The short answer to that, Ellie, is no, in terms of where we are today. If you look at what the federal government's put a light on the hill, essentially, to say that over the next 5 years, we need another 1.2 million dwellings in this country. Now, that's just to keep up with demand. That's not to solve the fact that we're already in chronic undersupply. So that's sort of 240,000 new dwellings a year. If you look at how we're going to go this year, we'll deliver around about 160,000. So once again, the first year of that 5-year target, falling way, way short. I mean, part of the solution is also not just, when we're talking dwellings, it's detached houses, but it's also apartment living as well and apartments. So CBRE estimate that we need 300,000 new apartments over the next 4 years, once again, just to keep up with demand. So that's 75,000 apartments every single year. Current estimates for this year are at about 60,000. And then you look at future years and it drops off further again. So once again, whether you're talking dwellings overall or whether it's just apartments, we're falling well short of where we need to get to. And that's why I say it's chronic undersupply now. If you look forward, it's actually going to get worse before it gets better.
What does that mean for prices?
Ultimately, it's putting a floor under prices at the moment. In fact, you're seeing prices start to escalate again. It's been quite, once again, extraordinary when you think about we've had 13 interest rate rises over the course of the past couple of years, which ordinarily would have placed a lot of pressure on values because it creates affordability issues. But because of that, once again, that stark demand-supply imbalance, if you look at the median price of dwellings in this country and go back and comparing it to 4 years ago, they're kind of 33% higher now than they were then, notwithstanding these interest rate increases. So I think what it essentially does, it places a floor under values. If anything, there's still upward momentum to be pushed through because you're going to have this continual supply-demand shortfall. The constraint's going to be affordability and sort of what that means in terms of the type of product that's actually delivered. But certainly, I know when rates started going up, there were certain economists in the marketplace saying rate prices were going to come back 15, 20, 25%. We just didn't see that. In fact, it's moved in the other direction.
I'm sure every Australian always wanted to have their own standalone home. Apartments, I guess, the new Australian dream or the new reality?
Yeah, I think it's probably the new reality rather than the dream, because you're quite right. Most people always think of the ideal home for them as a home detached dwelling with some land around it. The reality is that's just become increasingly unaffordable for people, particularly for first home buyers getting into the market for the first time. And once again, if you look at where prices have moved, during that whole COVID period where prices moved quite aggressively, there's this whole chase for space. So detached housing actually increased by a much, much greater level than apartments did. So if you actually look at the premium of houses versus apartments, and you go back to, let's call it back to say 2019, the premium was around about 16%. The premium today is 45%. So once again, it's just showing how unaffordable housing's become. Yeah. So that I think what that then plays out is that apartments are part of the solution. So we obviously need more supply to come through into the market. We need more affordable supply, and apartments can actually deliver that outcome and provide that entry point into the residential housing market for people that need a roof over their heads at the end of the day.
I want to distill a little bit more into the opportunity you're seeing today, given everything we've just discussed. How does the opportunity compare between residential real estate in private credit compared to with, office or industrial?
We've got really strong conviction in residential for all the reasons I just mentioned. And if you look at the residential market, and if you think about just even you're focusing on the apartment market, 75,000 new apartments every year for the next 4 years, if you were to deliver that and running on the median average house price and then average gearing of 60%, what that means is that you require $115 billion of capital, debt capital essentially, to be invested into that part of the market to deliver that supply. So for us, residential makes a whole lot of sense, and QRI, our real estate income fund, that actually points really heavily into that market with 88% of the exposure in that residential market. Having said that, Qualitas more broadly, we're quite market agnostic in terms of if there's opportunities in other parts of the real estate market, we'll look to deploy capital into that. So if you look at, say, the industrial market, warehouse, logistics, we've got strong conviction there as well. Much like residential, you've got a scenario where the supply that's being delivered is just insufficient to meet the demand. So once again, record low vacancy rates being evidenced by very strong rental growth within that part of the market. So very confident there. I suppose on the other end of the barbell is office at the moment. There's been a lot that's been written up on office and recently. So that's a part of the market that's obviously challenged. We wouldn't ignore the office market completely, because in any dislocated market, there's often opportunities there if you actually pitch into the right part of the market. So we think with office workers returning to the office, and obviously work from home is still going to be part of the landscape for a long period of time, but we're seeing more people come back to the office, and there's a requirement for a different sort of office space. So premium, high-end office space is still very much in demand. So we would still look at opportunities in that part of the market, and would also look at opportunities in maybe that B grade, C grade office, which is being repositioned back to an A grade or premium kind of status. What we wouldn't do in the office space are assets which we think are going to become stranded assets moving forward that are no longer fit for purpose for the modern working environment.
I want to talk about rates now, as obviously yields are impacted by rates, particularly when it comes to real estate. What's your outlook on rates over the coming 12 months?
Yeah, I think the reality is we're in an elevated interest rate environment for a fair period of time, and we may well get rate cuts in the back part of this year, and most economic forecasters are saying we will get rate cuts. But I think you need to keep in mind that inflation can be quite sticky, so it's hard to bring back, and even when it does come back into target, the Reserve Bank of Australia, and in fact central banks around the world, are still really hyper-focused on ensuring that once they get it back into band, that it doesn't bounce back out again, because there's still a whole lot of underlying inflationary pressure, particularly around services inflation in the market at the moment. So I think you potentially could get some rate cuts, but it's going to be fairly mooted. I mean, if you look at so the 2 and the 3 year interest rate swap markets and where they're pricing things at the moment, they've got rates sort of high 3s, so that the market is kind of forecasting you might get a couple of interest rate cuts in, bring you back from 435 to 385 or thereabouts. But I think it's going to sit there if you get back to that level, there's going to be a floor at that level for a fair period of time. So what that means for something like Qualitas Real Estate Income Fund, which is returning circa sort of high 8s to 9%, returns are, and in private credit more generally, they are very closely correlated to that variable rate because we earn a margin over that. Essentially, we charge borrowers a margin over that variable rate. So you may well find returns coming back slightly, albeit I think returns will still be really attractive on a risk-adjusted basis relative to other investment opportunities.
The portfolio is diversified across a range of different loan structures. Can you take us briefly through them?
Yeah, sure. So I think it's important to understand that when we're talking private real estate credit, it's not just one type of loan. There are a number of different loans that all get put together in a portfolio that provides an investor with really good diversification. So there's essentially 4 types of loans we have within our private credit real estate business. So that's essentially pre-development land loans. So these are land loans generally on infill city sites within 5 to 10k radius of the major capital cities in Australia that are expected to be activated into a live construction project in the next 6 to 18 months. Then we've got construction loans themselves, and they can be the first ranking loans or mezzanine or second ranking loans, and primarily they're against high density residential projects, apartment projects. And then we'll also do other developments, whether it be warehouse and logistics or office. We're not seeing anything at the moment because obviously it doesn't really stack, and retail as well. Then if you look at sort of completed product, we'll fund completed what we call as investment assets. So they could be income producing assets, that could be build to rent multifamily, it could be office, it could be once again warehouse, retail. And these are income producing assets that we'll fund. And then a subset of that are essentially repositioning assets. So they're assets that have kind of passed their time and they require capital to be invested into them to bring them back up to modern day standards. And then the final subset of those investment loans is what we call residual stock loans. So they're loans, it's basically a loan against a line of recently completed but unsold apartments. So you may have a developer who's developed, let's say 300 apartments in a project. They've sold and settled 200 of them by the time the project's completed, and there's 100 apartments left, and we'll provide a line of credit against those to release capital and profit back to the developer.
Where would QRI sit within a portfolio with that in mind?
QRI sits as a defensive investment for an investor that wants regular monthly income, essentially. Well, we generate our income within an M-rate by the fees that we charge the borrowers and the interest that we charge. And those borrowers are paying interest every single month. So every single month those returns flow straight through to investors. It's interesting when you're looking at, in terms of income credit, where it actually sits within a portfolio, because it can sit in a number of different areas. It can basically sit within property because actually the underlying security is property. It can sit within fixed income because of those income attributes associated with the investment, being the interest that you're charging on those loans. And then finally it can sit within the alternate bucket as well because of the fact that you've got an investment asset class that doesn't actually neatly fit within the other asset classes, but has some really strong defensive characteristics. So irrespective of where an asset allocator is looking to allocate private credit to, what it does provide is a really diversified, defensive investment asset class for either institutional or retail investors.
Well, thank you so much for your time today, Mark. We covered such a broad range of subjects within property. I'm really grateful that you joined us for our listed series today.
You're really welcome, Ellie. Pleasure to be here.
If you enjoyed that too, don't forget to subscribe to Livewire's YouTube channel. We're adding so much great content just like this every single week.